Good afternoon, everyone. I and my colleague Maulik would like to welcome you all for 4Q FY18 Results and Business Outlook Conference Call of Welspun Enterprises Limited. We thank the management for giving us the opportunity to host the call. From the management, we have Mr. Sandeep Garg, Managing Director, Mr. Akhil Jindal, Group CFO and Head Strategy, and Mr. Srinivas Kargutkar, CFO. Without wasting much time, I would like to hand over the floor to management for their opening remarks, and then we can have a Q&A. Over to you, sir.
Good morning and thank you. I am Sandeep Garg. Along with me is Mr. Akhil Jindal and Mr. Srinivas Kargutkar. I welcome the investor community on the call. I would like to brief you about the current status of the infrastructure. The current portfolio for the HAM model infrastructure is that we have an portfolio of about 7,000 crores, which includes a project of 2,000 crores where we have been declared L1 recently. The award is still awaited. Assuming this would be awarded, which we expect to be within the month of May, the current order book for the EPC business would stand at about 5,500 crores if escalated for the escalations that have taken place, and the change of scopes, it would be in the range of 6,000 crores, which gives us the visibility on the EPC business to the tune of 6,000 crores going forward. I am very pleased to inform you that the Delhi Meerut Package 1, which is our first project that got awarded, with an appointed date in the end of November 2016, is substantially completed, and we have applied for provisional completion certificate already. It is ahead of schedule by about 14 months. The scheduled completion was 30 months, as against which we have been able to complete it in 16 months, which will allow us to not only pre-pull the annuities, but also entitle us to the bonus from the client, which is approximately 0.3% of the contract value for per month basis. That is an additional advantage that should come to the company. In addition to that, there are two more projects which got their appointed dates in the Q4 of FY18. One is Gagalheri Saharanpur Yamuna Nagar, normally we call it GSY project. The appointed date was announced on the 6th of December 2018. 26th of January 2018. The current execution is currently it is under execution. As of the current status, we are quite hopeful that we will be able to complete the project ahead of schedule or on schedule. The other project which got the appointed date was the Chutmalpur, Ganeshpur and Roorkee to Chutmalpur and Gagalheri, CGRG. That's the project we call it. The project got its appointed date on 28th of February 2018, and the execution is in full swing. We also have in our portfolio two other projects. One is Anta Simaria, which is primarily a bridge project for about 1,161 crores. The appointed date, we have already done the financial closure for the project. However, the appointed date has not taken place. We expect the appointed date to take place within Q1 of FY19. For the project, we have already finalized our subcontractors. They have also mobilized the they're also mobilized at the site, and the developmental works are on way. So in terms of our business, it's practically de-risked to the extent of our, we are within our budgeted numbers for the award of the contracts. So we have de-risked the project substantially to from a financial perspective. The other project, Qtr4, we had acquired 49% from the Vishraj Group in the January 2018. I'm happy to announce you that we could do a financial closure for the project in a very short time. And we are expecting the appointed date for the same to be announced in Q1 of FY19. The subcontractor for the same has already been finalized, and the clearing and grubbing at the site is going on as we speak. So these are the projects that we have which should start giving revenues. Two of the projects have started giving revenues from the Q4 of FY18, and going forward for the year, we expect all these four projects to go on stream full swing and start contributing to the revenues. The other important project that I would want to touch base from the infrastructure perspective is that Devas Water, which got restructured, and we signed the concession agreement on 9th of January 2018, and the appointed date of the same has been received on 7th of May 2018, and the execution has already begun. The project that I have been talking about in the HAM that we won, we have been declared as L1, is Satanathapuram to Nagapattinam in Tamil Nadu. It is on 55.75 kilometer rigid pavement road. The NHAI estimate for the same was 1470 crores, as against which our bid price has been 1837.32. The project, we are quite hopeful that it should get awarded in the next month, within this month, or latest in the next month. Briefing you about the oil and gas, which is the other piece of the business in the company, where we are in a joint venture with Adani Welspun. To reiterate, there are 5 relevant blocks, 2 in Kutch, 1 in Mumbai, 1 in Gujarat, Palej, and 1 is a discovered small field which we won about 12 months back. These are the relevant blocks for the company. The 2 Kutch blocks are under appraisal, and as we speak, the rigs are on en route to the location for starting the appraisal program. For the Mumbai block, although we have a agreement or a in principle approval from ONGC to take over the PI, in light of it being very adjoining to our discovered small field B9, the management is of the view that we may be better served by doing the phase 2 of the Mumbai block ourselves. So we are currently contemplating doing it together with B9, the phase 2 well as well. The Palej block, it is under hold from the government side because of the problem with the Naftogas India. We expect the same to get resolved in next quarter or so either way. So this is on the oil and gas side. To take you through, I would also want to brief you about the future outlook for the infrastructure business. At this current moment, we have, in addition to the bid that we have opened L1, there are 2 bids which are of about 2,000 crores, which we have put in and are awaiting opening at the NHAI level. There are about 4,500 hybrid annuity bids which are to be bid out going forward for about 45,000 crores. We expect to bid at least 2/3 of these bids going forward. We are very hopeful that we should win at least additional 5,000 crores of orders from the future bidding that will take place in this year. Also, I would want to touch base that with the current order book, of about 6,000 crores on the EPC side, assuming that the Tamil Nadu project will be awarded to us soon, we will have a clear visibility of turnover going forward for the next 2 years. And at our current turnover of about 1,000 crores from the business, we have a clear visibility that we could actually double up our revenues for the next year and year thereafter. So with this, I would want to hand over the dash to Mr. Akhil Jindal to take you through with the financial highlights of the company. Over to you, Akhil.
Yeah, good afternoon, everyone. I'm sure the numbers, most of the numbers are already uploaded and you would have seen the numbers, but just a quick summary of what we did in the entire last 1 year. The total income that we booked in the full year was close to 1,100 crores, 1093 to be precise. We reported an EBITDA of 166 crore, which was 145% more than the last year. This EBITDA, of course, includes the other income and treasury incomes and others. So this works out to almost 15.2%. The PBT is 138 crores, again 225% more than the last year. The PAT was 109 crores, another 154% higher than the previous year. So the PAT margin of 10%, and our cash PAT is roughly around 106 crore. So this is what we have delivered in the last 1 full year. Just a quick snapshot on the balance sheet. Our net worth as on March 31st closing is 1457 crores, with a small debt of 66.4 crores and a cash of 713 crores. We are sitting on a net debt which is negative, or almost you can say the cash surplus of 647 crores, and with other small liability of 30 crores as a long term and a fixed assets of 8.7. Our net current assets is 105 crores as on 31st March. We have made an investment of 726 crore as on 31st March, which of course includes the equity in most of these HAM projects that Sandeep has said. Almost 350 odd crores has gone as an equity. 369 has gone as an equity in these projects. Plus, of course, in oil and gas, another 185 crores, which are 2 large big ticket items. And the miscellaneous are small investments in other businesses. So this is our snapshot on the balance sheet. Clearly, we have significant amount of cash balance with almost like a debt-free company at a parental level. And this debt also we are likely to retire in the first half of this financial year. So you can say that as a company, we would be having gross debt of almost zero and a cash and cash equivalent of close to 600 odd crores at any point of time. So this is what the current balance sheet is. Of course, the segmental numbers are all available with Clause 41 that we have uploaded on the BSE sites and other things. So from that angle, I think all this information is available. We can address any specific query that you may have on these numbers in our Q&A. So Sandeep, I think with this, we can open the floor for the Q&A.
Sure.
And happy to answer any questions.
Sure. Thank you very much. Ladies and gentlemen, we will now begin with the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Neerav Shah from GC Investment. Please go ahead.
Yeah, good afternoon, sir, and congrats on strong execution. Sir, first question is if we can have the project-wise execution for Q4. How much did GSY and CGRG contributed to the top line in fourth quarter?
The contribution of GSY and CGRG for the Q4 is in the range of about 300 crores put together.
300 crores. And 80 crores is on, Delhi Merit. 70 crores.
Yeah, 70 crores.
And that is almost complete.
Yeah, that's almost complete.
So, what will be the effective date for which we'll get the provisional COD?
See, we expect it to be issued somewhere in the end of March to end of April, any day between that.
Any day.
With effect from that day. That's how the PCODs normally get issued.
Mm-hmm.
So we had completed substantial work by that time. However, the process takes some time for the issuance of PCOD. So we'll exactly know next week when we get the PCOD issued, but we expect it to be somewhere in those days.
Got it, sir. And sir, in terms of our equity investments for FY19, how much are we planning to invest in HAM projects and in oil and gas separately?
Oil and gas, over the next 2 years, we expect to invest somewhere around 150 to 175 crores. As far as the investments in SPV is concerned, we have approximately...
so without considering the Tamil Nadu project that we have recently won, the total equity invested till 31st March was 360 against our total commitment of 480 crores. So almost 120 odd crores need to be invested further in this financial year on the 5 projects that we have. Tamil Nadu, of course, is a new project. So part of the equity commitment will happen in this year and a part may spill over the next financial year.
Got it, sir. And so just the last question, can you just briefly elaborate on our strategy for our foray in inland waterways and by when do we see some traction in terms of bidding and everything?
So the team is right now, as we speak, the team for the water is under being put in position. We have started scanning the market and estimating the total potential. There is definitely a synergy within the group for us to get into the water segment. So we expect that we should have the team in place in the Q1 and we should be in the market for bidding by the Q2 of FY19. Our intention would be to take some baby steps and try and book orders within FY19 of about 1,000 crores.
Got it. So is this part of, on the media you mentioned that you want to end the year with 7,000 crores. So this would include 1,000 crore of...
no, this is that's only from the hybrid annuity model.
Oh, great, sir. Thank you, sir, and all the best, sir.
Thank you.
Thank you.
Thank you. We take the next question from the line of Abhilasha Satale from the Dalal & Broacha. Please go ahead.
Yes, sir. Congratulations for a good set of numbers. Actually, I want to understand more on accounting terminology because, I'm seeing receivables in the balance sheet. I'm seeing receivables given in 3 times, 3 varieties like service concession receivable you have given below investments. Then in fixed assets also there is service concession receivable and actual, receivables in the current asset. So how is it accounted for and how will be treatment for for calculation of operating cash flows?
Yeah, Kevin, would you like to...
There are 3 categories of receivable. Firstly, there is actually we consider it as 2 categories of receivable. One is the service concession receivable, which is emanating from the financial asset. So earlier we used to capitalize this as a capex cost. Now we have to under Ind AS classify this as a service concession receivable. Within service concession receivable, whatever is receivable in short term, let's say 12 months, we classify that as a current portion of service concession receivables. Balance is something which we will receive beyond 12 months. And trade receivable which you are referring to is actually pertaining to actual receivables which we all understand in normal terminology, debtors.
So this long-term service concession receivable, is it working capital, capital work in progress? Actually, it is something like we used to capitalize it earlier as a capital work in progress or intangible asset. Like once, let's say, currently it is an intangible under development in traditional language. And under Ind AS, it is long-term service concession receivable. Okay, so while calculating operating cash flow, we have to consider all these receivables under working capital.
Only short-term service receivable is something which you should consider, and trade receivable.
Okay. So this service concession receivables will be on the balance sheet unless that project is undergoing a particular project. Once that gets completed and actual cash flow start coming, this will means. Okay.
I'll just clarify that long-term service concession receivable will be there in our balance sheet for next 15 years. So as soon as and when we keep on receiving the cash flow from the government, this will get reduced over the period. So in traditional language, it is nothing but an intangible asset, what we all understand.
Okay, fine. Thank you.
Thank you. We take the next question from the line of Gautam Bahel from Orient Capital. Please go ahead.
Hi, good afternoon. Thank you for taking my question. Mr. Garg, when you said revenues to double each of the next 2 years, which comes to 4,500 crores, would that be purely from infra, or would that also include some of the other income and things like that as we currently have?
I am talking purely from infra because that's the infra order book that we are looking at. So if you look at it in infra revenues, there are close to 1,000 crores there, and we have 6,000 crore EPC contract visibility right now. So we expect at least the next year for us to be having a revenue out of this of about 2,000 crores and going forward another 4,000 crores. So that's the simple math there.
Great. I just want to clarify that. And so second, on the infra side, the EBIT margin this quarter was 10.9%, which I thought was slightly lower than what I would have expected. What is the sort of outlook on that in the next couple of years?
The EBIT margins at 10.9% is because a lot of projects are under mobilization and the certain costs have been repulled. So on a stable basis, we expect the margins to be higher. The stable EBITDA margins that we expect from the EPC business to be in the ranges of 11 to 12%.
And that's EBIT or EBITDA? EBITDA, you said?
Yeah.
EBITDA 11 to 12% on EPC.
On a stable business basis.
On a stable basis. And so the new projects that we are L1 for, they would also sort of, what I'm trying to understand is, has the competitive intensity sort of increased, that margins are coming lower, or?
There were only 4 bidders on this bid. So from this bid perspective, the competitive intensity was not huge. And as you know, we have our standards of bidding where we bid at a particular return rate and no less than that. Hence, we are kind of clearly, regimentalized in bidding process. No matter how the competitive intensity is, we stay to focus with our return expectation, and that's what we bid for.
Cool. And my understanding is correct that EBITDA and EBIT is not very different for us, right? Because there is not much depreciation.
Yeah, there is very little depreciation for us. Because we want to stay asset light in terms of our way of executing the businesses. So as a strength of the business, we always would consider that we would want to stay asset light. We would want to churn our completed projects as soon as they are complete so that we can unlock that value as well. So that's the way we will be conducting ourselves going forward. There will always be a respect for capital that we will continue to demonstrate.
That's great to hear. And sir, just sort of following on from that answer you gave, Delhi Meerut, what are the thoughts on sort of reinvesting those cash flows now and unlocking that value?
As soon as we get PCOD, we are entitled to churn the asset to a certain extent, and we would be very happy to look at those options if we can get long-term capital, low-cost capital to take over these annuity returns.
Okay. But the O&M revenue and EBITDA from that will keep coming to us?
We are flexible as far as we are concerned that whether the incoming investor wants to do the O&M themselves or would want us to do it through us. We are flexible on that. And we are happy to do the O&M if they want us to do.
Okay. And so just last question from my side. The bonus from Delhi Meerut, what is the total quantum of that for the 14 months that we'll be entitled to?
We approximately about 34 crores. We will compute it as and when we get the PCOD. So I don't want to be held to this number. Once we have the PCOD, we will know exact numbers. However, approximately it is in this. However, we share our bonuses with our subcontractors, so there will be a sharing of the bonus that we get to the tune of about 50%.
50%. Okay. Thank you, sir. Thank you very much.
Thanks.
Thank you. We take the next question from the line of Dimple Kotak from SKS Capital. Please go ahead.
Yeah, hi, sir. So, 700 crores, we have cash on the books. So, how much is earmarked already for oil and gas and our infra projects going ahead, and what would be the quantum of the free cash flows?
So, basically, as you mentioned, 120 odd crores is a fresh equity requirement in our projects currently without accounting for the Tamil Nadu equity.
And so if Tamil Nadu comes in, because we are already L1, so what would be the...
Yeah, so if I take Tamil Nadu also, it would be close to, let's say, 200 crores. I'm just doing a very rough math on that.
Correct.
220 crores would be the equity requirement.
Okay.
And hopefully some equity churn would have happened on Delhi Meerut by that time. Mm-hmm. So maybe our net investment would be in the magnitude of around 100 crores. Okay. So you can say 200 to 250 crores will be required as a fresh equity for the project.
The HAM projects, yeah.
For the HAM project that we already have.
Okay.
Plus another 150 to 200 crores on the oil and gas side.
Okay.
Yeah, and that also over 2 years, not immediately.
So around an investment of 450 to 500 crores over 2 years.
No, so the oil and gas side would be requiring around 200 crores over 2 years.
Okay.
The HAM will be requiring another...
in FY19?
Mostly in FY19, some part in FY20 of around 250 crores net.
Okay.
So that is a commitment so far, and based on the project that we will run further, these numbers might go up. So basically, I think the cash is enough for us to be clear in terms of the 10,000 crore order book that Sandeep just mentioned.
Yeah.
And with the churn that is possible with us, as the projects are going to get complete in some in FY19 or let's say in the beginning of FY20. So we would have enough headroom.
We expect, yeah. Please, sir, please go ahead.
No, I'm saying we would have enough headroom to funnel the growth through this cash that we have in the books.
Okay. And we expect an order inflow of around 5,000 crores this year.
Yeah, that's 5,000 crores in addition to the project that we have opened.
Exactly, yeah. And so for the EBITDA margins of 11 to 12%, that would be including the other income?
No, that will be purely from infra play.
From infra play. So currently it's around 4 to 5%.
No, I think there is we don't understand where it is coming from as a 4 to 5%.
So if there is 172 crores of your EBITDA and 129 crores of other income. So if I deduct that from if I deduct 129 crores from your EBITDA of 172 crores, it comes to 44 crores, and our sales is 1067.
Yeah. So let us try and there are certain.
What we can do is provide you the bridge. Certainly it is not 4 to 5% that what you are mentioning.
Okay.
There are expenses also with respect to the other income which are separately booked. So why don't I tell Harish to call you after the call and provide you all the details on the EPC margin and other income versus other expenses.
Sure.
And just to clarify, to add to a point of what Akhil has said, that the other income is not purely the treasury income that you would kind of assimilate.
Okay.
So that is the underpinning assumption.
The treasury income is only 75 crores out of what you just mentioned.
Mm-hmm.
So there are many items where there is another income. There are expenses also correspondingly.
Okay.
Which are more like a accounting entry index related.
Mm-hmm.
Which, all the details Harish can provide you.
Okay. Sure, sir, sure. Okay. Thank you so much, sir.
Thank you.
Thank you. We take the next question from the line of Giriraj Daga from KM Visaria. Please go ahead.
Yeah, hello team. Couple of questions from my side. First, few on the number side of it. If you look at the segment performance, there has been a bit of unusual activity in oil and gas and the unallocable expense. So if you can just throw some light there. So we saw that losses actually reducing sharply there. Is there any one-off there?
Just give us a second.
Yeah.
You're right. I think last time what you can see was one of the item in one of the write-off was there. This year there is nothing like that.
No, but what I'm looking at is that like last year also there was a 12 crore of unallocable expense which has come down to 3 crore this time.
Unallocated.
2.7 be precise.
That's correct.
And even the QOQ also it was 23 crore. So then, okay, by goodness, there was some certain write-off, but year on year also it was higher number. So this 3 crore looks very low. Is there any one-off gain we are included there?
No, this is some. There are some ratios. Numbers are based on some ratios, and as our operation goes up, this number has to ideally go down. So if you look at our last year's revenue numbers and all, comparatively current year there is a increase because of which this numbers looks going down.
Not able to actually reconcile. I thought this was more of a overhead cost, fixed overhead, which was not allocable to either oil and gas or the either infra segment.
In overhead, we have two sorts of overhead. One would be which is purely not allocable in any proportion. It's directly unallocable, not related, nowhere related to infra. And some unallocated costs which are sort of attributable costs to infra and other segment where it will be based on certain ratio. So that's the reason as operation goes up, those ratio-based overhead will go down.
So the next year number would be a multiplication of this fourth quarter number?
It's a little difficult to predict, but logically you may be correct.
Okay, and how about oil and gas also? We saw just a number of 10 lakh lost there compared to 3 crore run rate what we are seeing.
3 crore had some one-off item.
So there also it's over now for time being?
We can say so.
Okay. And in terms of order inflow guidance, you talk about 5,000 crore of fresh order in the infra side of it. Any like ballpark thing or ballpark idea on the FY20 numbers? What can be that looking like in terms of inflow target?
At this point in time, there is no clarity of from the NHAI, the guidance as to what they will be bidding out in FY20. So anything that we would tell would be crystal ball gazing. So once we have the clarity of the canvas that NHAI and MORTH put together with put in hybrid annuity model, we can make our own assessments. So,
let me put it this way, maybe not the guidance per se, but do you believe that our balance sheet will support additional 5, 7 or 8,000 crore of inflow in FY20?
As Akhil was putting across, once the current assets which are likely to be completed in the FY19 or early of FY20, if we are able to churn, surely it can support another 5,000-7,000 crores of order book without needing cash.
Okay. So what is the SPV debt in Delhi Merit and total SPV debt?
372 in Delhi.
372.
372.
As on 31st March, which of course we have a sanction of up to 400 crores. We are expecting the closing debt to be in the range of around 390 crores.
Okay, and this is only for Delhi Merit, right?
That's only Delhi Merit, yes.
And out of the other SPV?
So small in Kim Mandvi, 21 crores.
Okay.
So I think that's it. I mean, these are the two debts that you would have got in our standalone versus consolidated.
Okay, my last thing on the oil and gas segment, like what kind of visibility in terms of the starting of the production basically? What kind of any guidance you want to give there?
We expect that the first field for which we are doing the field development right now, the B9 discovered small field, we expect the revenues to start in FY20.
FY20 and the beginning or maybe any timeline there?
By the Q3 or Q4.
Okay, sure. Thanks a lot and all the best.
I would also want to, taking a cue from your question, I would also want to say that the Kim Mandvi project, which has a small debt, has also been, foreclosed with the client. So that debt has been repaid in the Q1 of FY19, and the project stands closed as far as the company is concerned.
Okay, thanks a lot.
Thank you. We take the next question from the line of Viral Shah from Emkay Global. Please go ahead.
Hello. Good afternoon, sir. Congratulations on a good set of numbers. Sir, couple of questions. One, when you look at your EBITDA margin for the quarter, that is excluding the other income, it stands at around 7%. So going forward, do we expect this trend to come back to around 10 to 11%, or how it will be? That is excluding the other income I'm talking about.
See, there are two parts of this question, two parts to this answer, this question. Number one, since you are taking off the complete other income off from the computation, as Akhil had clarified, the other income constitutes of two numbers. One is that of treasury income, and the other are certain notional entries, wherein there is a other income at the top, and there is a corresponding cost in the other expenses. So, if you take off the complete other income, there is a skew in the numbers, which Akhil had told that Harish would clarify going forward. The only point that we would want to say that right now the other income, only 75 crores from the other income is the treasury income. The rest all cannot be attributed to treasury. So that's something which you should not be taking off.
Okay.
On a yearly basis.
Okay. And for the quarter, I believe it is 17 odd, if I'm not wrong.
Yeah.
The treasury income.
Yes, 17, 18, whatever the numbers are.
Yeah. And secondly, since two projects have started execution, if I recollect in the call, you had given a guidance of around 2,000 crores of revenue for FY19. Is the guidance correct?
That's correct. We expect the turnover to be in the ranges of 2,000 crores going forward.
And for FY20, it would be around 4,000, if I'm not wrong.
Yeah. So given that we have an EPC order backlog of about, should have an EPC order backlog of about 6,000 crores, which we intend liquidating in the next 2 years. So that would be our anticipation for the FY20. I would, rather than saying as a guidance, that's the high level indication that is possible.
Okay. And in the projects which are operational currently, where the execution has started, do we envisage the early completion as well in those projects, or still we are looking at?
It's early days of the execution right now, but as a plan that we have as a company, we are trying to create certain strengths for the company, and one of the strengths that we are creating is an operational excellence. So every project that we bid for and we execute, we are focused on early completion and quality project in a safe manner. Okay. So this is going to be the hallmark of every project that we are trying to execute. How much we will succeed in each one of them, we do not know. But that's going to be the attempt to complete all projects ahead of schedule. And as I said, since the ahead of schedule project execution also gives us a benefit in terms of financial results and is a respect for the capital. So that's going to be our mainstay of one of the pillars of the Welspun Enterprise to stay different, or one of the USPs that we would have. Also very important for us will be to de-risk the business as early as is possible. And so we are since we are not the self-executors, we have the ability to select the contractors who are best suited for a particular job, which gives us the ability to execute it in the fastest and the most optimal manner. And these are the few things that we will continue to do going forward.
Agreed. Secondly, sir, in terms of cash, we had a cash balance of around 1,000 crores last quarter, and this quarter it is around 700 crores. So we have invested on 300 crores of equity in the HAM portfolio. Is the understanding correct, or that 300 crores has gone somewhere else?
Gone into the funding of equity, because practically we started 3 projects in this quarter.
Yeah.
Obviously, most of the equity requirements are to be infused upfront. So you can imagine that,
Agreed. And secondly, sir, your current investments have gone up significantly. What will be that portion, and what is that regarding to pertaining to for the year as a whole?
Sorry, would you repeat your question?
Your basically non-current investments, when you look at on the balance sheet side.
Yes, so the non-current investments are basically investment in subsidiaries only.
Okay.
Which has gone up. So these are the equity investment that I just
on the HAM front, right?
Yeah, on HAM front, yes.
Yeah. Secondly, and lastly, in terms of strategy, when you look at going forward, I remember we were looking at monetizing the oil and gas blocks. But on the opening remarks, what we understood is we would not be monetizing the Mumbai block pertaining to, because so is the strategy change for us, or it is the same going forward?
As I had tried to clarify, the reason of re-looking at the Mumbai block was that it is absolutely adjoining to our discovered small field B9. Actually, one of the edges is touching the Mumbai block. So since we were mobilizing for drilling in B9, there was a rationale to say additional one well. Do we need to mobilize another rig and divest at this point in time, knowing fully well that on both sides of that block, ONGC already has found 2 wells, which we can see in our seismic, that the veins are passing 70% through us, to transfer this to ONGC, and we decided that it was prudent and it will create more value for the stakeholders if we were to drill the additional well. So that additional well drilling would prove the reserve and hence allow us to have a better monetization of the asset.
But so we are not. So when do we expect the revenue to come in?
See, this revenue from in oil and gas, it's a long gestation period business. So once you have proven the reserve, that there is a find, then it goes into an appraisal program which takes 2 to 3 years, and then once you appraise the field, that it takes about 2-3 years to do the field development of it. So post the finding of the gas, it is about 5 to 6 years before you see the revenues. However, in this case of the Mumbai block, since the infrastructure of ONGC is adjoining and they are keen to join this particular block alongside with us, I expect the monetization to be quicker than taking 4 or 5 years.
Okay, fine. Fair enough. And all the best for future. Thank you.
Thank you.
Ladies and gentlemen, we have lost the line for the current participant. We proceed to the next question. It's from the line of Devyata Dalal from Systematic Shares. Please go ahead.
Yeah, good afternoon, sir. Congratulations for very good set of numbers. Sir, my question pertains to the order book of 6,000 crores which we mentioned currently. Will it be possible for you to provide a breakup of the same project-wise?
I think we can, just can you open it up? Just give me a second, I will...
Sure, sir.
So the unexecuted orders are to the tune of about 25-30 crores in Delhi Meerut.
Right.
The Antasam area is about 980 crores, about MBL, CGRG and GSY put together about 1,700 crores. Chikli Tarsor about 1050 crores and about 60 crores for Devas Water. And the project that we have opened L1 about 1,650 crores. So that should add up about 5,500 crores. And
okay.
As I said, this excludes the escalations and the change of scope. So which should push this whole thing up to about 6,000 crores.
Change of scope would be in which projects we would have seen?
The change of scopes are in practically every project other than possibly Antasam area. Every other project will see some change of scope to some extent.
Okay. And sir, in terms of the order inflow guidance, which we said additional 5,000 crores in the infra side, is excluding the AP project which we won recently, right?
The Tamil Nadu project?
That's a Tamil Nadu project, yes.
Yeah, that's excluded, for sure.
And the 1,000 crore of inland waterways also excluded in this?
Yeah, we are not right now counting on waterways. That will be our desire to set up the water business. We are still in the stages of getting the team onboarded. Once we have the team onboarded, we will develop a business plan, but the intent is to try and take some baby steps in this year and see if we can book an order book of about 1,000 crores. It is, as you know, is a synergistic play from a group's perspective.
Right.
We already have some experience on water in both in terms of Devas Water and EPC project in Mohali, which allows us to expand this business going forward.
Okay. And this would again be on the HAM side, right? Waterways?
Not necessarily. It could also be on EPC business for water.
Okay. Fair enough. That's it from my side. All the best, sir. Thank you.
Thank you.
Thank you. We take the next question from the line of Tarun Kaushik from Yes Bank. Please go ahead.
Hello.
Yes, sir.
Yeah, hi. Basically, questions regarding your whether Welspun at one time had also investments in BOT assets. So, what is the strategy going forward on that? Given the fact that there are a lot of BOT assets which are available at a good price right now, given the de-risking that's happening by a lot of banks. Then, what about the TOT bids? Would Welspun Enterprises be looking at bidding for any of these? Then on the steel side, I don't know whether the steel business is kind of related to Welspun Enterprises, but or will there be a separate call to understand what's the strategy for the steel subsidiaries that Welspun Group owns? That's number 3. Number 4, if you can just elaborate a little bit on why there is so much cash in your balance sheet. Is your EPC model dependent on the fact that you get a lot of advances from the government and then basically work? Why is there so much cash on the balance sheet, unlike most other EPC companies? Thanks.
There is no direct correlation between Welspun Enterprises and the steel business, so we would not be able to comment upon that. You probably will have to.
No, there's no equity. There's nothing that we own on the steel side.
No, I asked because Akhil Jindal is on the call and I think he's a group CFO, so I just want to understand that. So we'll have a separate call on that. Thanks.
Yeah. So answering the first two questions, are we looking at the acquisition of the boot assets or dabbling in TOT? The answer is, at this point in time, we are not. We don't close doors for anything. If there is an opportunity which comes in, which we believe needs our rethinking of a particular thing, we will. But at this point in time, there is no thought process of those two directions. The last question was about the cash. The cash has been because of the prudent decisions that were taken for last 3 years. We exited the business from Leighton Welspun and got a cash of almost 600 crores. We exited the businesses of energy, which gave us a cash of another 300 crores. So it is the prudent decision makings in past to create a war chest that is resulting in the cash that we have. We are not. I don't think any of the cash represents the advances from the client.
So what is the plan for the cash? Because return equity is around 6% based on your latest numbers. So why don't you return the cash to the shareholders?
We already have declared a dividend of 15%. So we are sharing the monies. However, as I said, as Akhil also pointed out, with the growth in the business that we see from 1,000 to 2,000, 2,000 to 4,000, we believe that this cash can be deployed very effectively in the business and get better returns than returning it back to the shareholders. And if you would recollect, we did a buyback about a year back as well, wherein we were willing to buy about 25% and only 15.5% was tender. So it is. We are trying to share the results of the company or the profits of the company with the shareholders, and we do believe that there is a fruitful deployment of the cash going forward as the business grows.
There's a kind of disconnect.
Kaushik, I'm sorry to interrupt, but
just need to understand this important point. There's a disconnect here. You got a 10,000 crore order book. The maximum cash required for executing based on net working capital of such an order book would be 100 to 200 crores. You've got cash of around 720 crores as on FY18. So the remaining 500 crores is actually not really value accretive to the shareholders.
I think I don't understand your maths. If we have an order book of 10,000 crores,
the missing link is the equity contribution that we need to put in.
There's a 10,000 crore order book. Typically, you'll have receivables and payables. The net working capital will not exceed this much.
No. Look, the missing link is the equity investment that is required in these projects also, which of course in 2 to 3 years time gets paid for. So we have a.
For that you can do a bank guarantee, right?
No, equity payment. Look, all this project needs equity. We are a developer. We are not just the EPC player. We are the developer. And as a developer, we have to put in our own share of equity in all these HAM projects. So as I mentioned earlier in our call, we have almost 300 crores of 250 to 300 crores of further equity requirement in the projects that we have. Plus, of course, there is an oil and gas business. So all in all, this cash is more or less earmarked, and it will as Sandeep mentioned, generate a decent amount of returns for the shareholders.
Mr. Kaushik, are you done with your questions? Thank you. We take the next question from the line of Vivek from GS Investment. Please go ahead.
Sir, congratulations on good set of numbers. Yeah, hello.
Yeah, please. Yeah.
2, 3 queries, sir. There has been some slight fall in the margins. Is it due to our policy of employing subcontractors and not owning the equipment? And due to the huge amount of work being given in the sector, is the subcontractor also fighting for higher margins? Number one. Number two, the Ata Simaria commissioning date, it's getting postponed again and again. Is there some sort of a problem in that, sir?
Okay. First of all, responding to your question of whether the erosion on the profit is because of the any increase in cost of subcontracting, the subcontracting is on a fixed price basis. It does not reflect any of those variations. There are no such pressures on the margin. The reason of you seeing a small drop could be that there is an increase of cost on projects because we were expecting them to be starting much earlier, and we had started building the teams for that. Those costs have been incurred in advance before the actual revenue started to come in, and that's the part of a growing company that you will need to build up the teams in advance. So till the time we come to a stable operation level, quarter on quarter there could be some variations because we may pre-pull some expenses. So that's the only reflection therein. As far as the Anta Simaria appointed date is concerned, it is primarily from a perspective of we had forecasted that it will be somewhere in the end of Q4 or early Q1 of FY19. The reason is that there are certain farming areas where the farmers had already put in the crops. And as you know, the farmers, once they have put in the crops, the land, even if you have paid for, it can only be taken over without a major resistance once they have, harvested the crop. The harvesting of crop has taken place at the end of April. So we expect those lands to be cleared and handed over to us now.
And sir, how is the progress of GSY and other projects happening? I believe the commissioning date got postponed over there also. And any other stressed assets we are trying to procure?
Let me first clarify that this is not the commissioning date, that's the appointed date. Appointed date is a function of of me meeting the obligations of the condition precedents, which is the financial closures, etc., and the land availability from the client end. So the client at certain times may not have sufficient land, and it can delay to de-risk the business. We do not take over the project or get the appointed date issued of a project unless we have an absolute clarity that the project can be completed in the time frame that we are set out to. So these delays are more from a perspective of de-risking the business so that we have enough land availability so that we can progress the project at the rate that we need to. So there is no concern as such. It is primarily a de-risking exercise that we do.
Got it, sir. And any other stressed assets, sir? We due to cash position in ours, so are we able to get hold of any good lucrative project for us, a stressed asset?
If
Maharashtra project we got, no? That was any date has been appointed for that particular project also, sir?
As I said, we expect it in Q1 of FY19. The financial closure is already done. So it's only a matter of one more agreement to be signed with the government, and the appointed date should take.
Okay. And the opportunity size remains intact for our sector and our company, sir?
Yeah. Sector is definitely, as you know, the sector is definitely the sunrise sector. And as a company, since we are one of the few companies which has a very strong financial balance sheet, we have a very good operational excellence that we have done in Delhi, which has created a lot of goodwill with the customer. And we have been very prudent in our bidding strategies. So we expect that as a company, our futures are very much secure.
But sir, I saw your work in Meerut Expressway, and it's really good and exemplary. But still, it boils down to L1 basis only, or is there some edge which we are able to get because of beautiful execution we had in terms of more technical ratings or something, techno-commercial bidding, something of advantage which can accrue to us due to this wonderful execution of Meerut Expressway first phase?
Yeah. there are a few things that one I would suggest that this question you also raised to the ministry and the NHAI for them to incorporate the performance into as a criteria of evaluating for future bids. However, that notwithstanding, just because we have executed so well, if there is a stressed project in NHAI stroke MOC, they definitely recommend it to us because to the concessionaire that they approach us because they know if we take it up, the project is going to be executed in a better manner. So that opens up a lot of opportunity for us. And as we understand, NHAI has now started rating the contractors or concessionaires going forward, and we believe it will be a matter of time before this becomes a part of their evaluation criteria. We hope it is sooner than later.
Yeah, we saw that in that Muzaffarnagar, Dehradun, Haridwar Expressway, horrible situations that years have elapsed and the progress has not happened much actually. And so some weightage more should be given technically also, I believe.
Thank you for mentioning it. I would suggest that you do mention this to in your interactions with the leaders of NHAI and MOC.
Okay, sir. Thank you very much. Keep up the good work, sir.
Thank you. Thanks a lot.
Thank you. Well, due to paucity of time, we will take the last three questions. Next question is from the line of Ankit Kumar from Bond & Securities. Please go ahead.
Yeah, hi. So for this year, as I understand, the treasury income was about 75 crores out of other income of 95 crores. So, and in the bottom line, if we see total comprehensive income of 108 crores, 55 crores, that is roughly 50% of the total income after tax was from these treasury operations. Now this year, due to greater equity outlay and the capex plans for oil and gas, the cash in hand would reduce, which would reduce the other income also. That is from the treasury operations. So can you give a guidance as to how much this could be, first part? And second part, the other income, the other part of the other income, which is 95 minus 75, 20 crores, what, I mean, if the scale of operations grow, is this other income also going to grow or it's going to remain stable?
Yes, the two parts. I think treasury income is one question that you asked. So we believe that the company will have an average value of 100 crores. So with the prudent norms and the guidelines that the board has kept treasury investments, we believe anything between 8.5% to 9% is the right number for us to look at that. So if I consider 400 crores as an average cash balance during the year, maybe at 9% we are looking at, roughly around 9 into 4, 36 crores. Let's say 40 crores as a treasury income. A very, very rough back of the envelope calculation. So that's question number one.
On question number two, this difference between 95 and 75 is related to certain adjustments. More or less, it would be in the same range.
Yes, this is. I think you should understand this a little bit more because you would see this as a repetitive item. So, given what just explain a little bit.
Broadly, from this 20 crores, significant chunk of amount comes from a notional entry of Ind AS, which is actually some portion of interest, loan within the group. That's the index implication. So what happens is one aspect put into as a notional interest income, and one aspect of is captured in the other expenses, which is also related to Ind AS. So it's a grossing up which is happening, and practically we, for our internal purpose, try to remove this while calculating our EBITDA overall.
Yeah, the reason why I asked, thank you for the explanation. The reason why I asked this is, the next year we're targeting revenues of about 2,000 crores from the infra business. The bottom line after tax comes to about 5.5% to 6%. So an incremental 1,000 crore revenue would bring in about 55-60 crores of profit after tax, and the treasury income would reduce from 75 to 40. So a net plus 55-60 and minus 40 crores when we look at the bottom line after tax. So the treasury income would reduce by say half, and the infra income would increase by 6% of 1,000 crores, which is about 55-60 crores, roughly basis.
We just don't understand this 6%. I think, as we have said, the stable EBITDA margins or the EBIT margins would be in the ranges of 11-12%. work the numbers of, that's the forecast, is on that basis. So rather than on a basis of
the current Fed numbers.
Current numbers, because that's possibly a misnomer.
But sir, even for last year or for this year or the quarters of these 4 quarters of this year, the EBIT, I agree, is about 11%, which should be about 11-12%. But when we remove the treasury income and see at the profit after tax, as a percent of income of infra, it does come to about 5.5 to 6% is what I'm trying to say.
So are you taking out the interest on the treasury as well from there? So
yes, absolutely.
Double dipping or triple dipping here. So I think the numbers need to be put in perspective. If you are taking off the income of 75 crores, you need to take off the taxation associated with that.
Absolutely. Taken out, sir. Taken out. So the treasury income is 75 crores. I've assumed a tax of 30%. So it comes to 52.5 after tax income from treasury income. Correct me if I'm wrong.
So I think it's too detailed for us to go into this call. I would suggest that you get in touch with Harish if you need to understand these numbers a bit better. But all I can say to you is this computation doesn't seem to be the computation that the way we see it.
Okay, sir.
So I would strongly recommend if you could get in touch with Harish.
Sure.
Take you through these numbers alongside with Kevin.
Sure.
Thank you. We take the next question from the line of Anil Daga, individual investor. Please go ahead.
Good afternoon, sir. Congratulations to the team for the strong set of numbers. I had a very small question pertaining to, what I see is competition is bagging a lot of projects. And on the other hand, if we look at, say, the ratio of cash available to us to our order book or our total revenue, that's pretty less. So I was hoping that we will be very aggressive in, bidding for orders. And on the other side, I also understand that we have to be prudent to protect our margins. So is it that our margin requirements or our return thresholds are higher than competition, which is resulting in, say, a lower than expected order inflow?
Let me say that I don't know what the competition is thinking. As I had said in the last year's discussion, we wanted to book an order backlog of about 4,000 crores, which we achieved last year. We are very prudent in at what rate of growth we should go for it to become sustainable. So a prudence in bidding and prudence in execution. So execution excellence will also come because you need to build up the organization to be able to deliver it on a consistent basis. So everything that we are doing has an aspect of sustainability and prudence there. We have our own set of return expectation, and we do not compromise it, no matter how intense the competition is or what the principles is that we have a lot of cash or not. It's this cash which allows us the flexibility to push the jobs the way we could push the Delhi Meerut project. So this is something which we will maintain going forward. This will be a USP, as I said, for us, that we will be prudent and we will be concentrating on operational excellence. So you would not see us go berserk just because we have the potential to generate money that we will go berserk in booking the orders.
Okay, thank you, sir. My next question is, considering that hello?
Yeah, go ahead.
Yeah, I thought I was not audible. So, considering that, the opportunity size is so large, do you think that, so this year I understand that the cash which is available will be sufficient to, build the order book for this year as per our projections. But do you think there will be equity requirement, some kind of dilution which will be required or something of that sort which will be required, say, for building the order book of, say, FY20? I
think it will all depend upon how the order build takes place, and it will all depend upon how the water segment shapes up. To answer your question, at this point in time, we do not foresee any need of cash for FY19, FY20. However, if the business grows at a pace faster than what we are currently forecasting, we don't know the answer. So we have not applied our minds towards that.
Okay. And my last question is, so you mentioned at various points of time that, you have certain return threshold requirements and you want to have prudence to generate the required returns for the shareholders. So, I understand that right now our business is growing up, it's scaling up, it's nowhere near, say, a stabilization kind of a phase, but say maybe next year will be a stabilization kind of a phase. So in that, what kind of return on equity you all are trying to project or, deliver to the shareholders?
See, the numbers that I said, we expect the infra numbers to be in the EBITDA to be in the ranges of 11 to 12% going forward. So these are the numbers that we would be returning, we would have available for the stakeholders to take credit of. Now, that's the best estimate that I can give you.
Okay. Thanks a lot.
Thank you.
Thank you. We take the last question from the line of Devraj Radha, individual investor. Please go ahead.
Hi, sir. Can you, sir, please help us to understand this oil and gas, where in the Q3 presentation it was mentioned value accretion expected of around rupees 5 billion. Sir, is this expected in this FY19-20 or over a period of time?
It is over a period of time when these assets that we have under the exploration stroke discovered stage, they all will start generating revenues. That possibly would be our estimate of what these business could throw up.
Okay, and
not happening in near future. So the first revenue from oil and gas at the earliest will be in FY20.
Okay, so that will be in FY20. And sir, if crude prices go up, will it be having any, again, effect or some contract is fixed only with ONGC?
See, in terms of oil and gas, the oil and gas is, other than the discovered small field business, is a controlled business. So not very much changes in terms of profitability on when the crude prices move for the oil and gas operator.
Okay, sir. Thank you.
Thank you.
Thank you. We take the next question from the line of ASN Raju. Please go ahead.
Yeah, good afternoon, sir.
Good afternoon.
Sir, I'm happy with all the things happened from last 3-4 years. But I want my company should execute by own to an extent, sir. As the competition is gearing up, why can't we have our own execution team, at least for 1 or 2 projects?
Mr. Raju, this is a kind of a decision at the operating level, and the rationale, as to the best of my understanding, is, as I've been trying to explain, is the company currently has a clean canvas. We are not boggled down by the capital assets of past, the construction equipment of past, the manpower sitting. Now, if you look at most of the EPC contracting businesses, if they are going at beyond a particular rate in the business, which is wherein we have an expectation of a very rapid growth going forward, they need a lot of money in terms to be deployed for the construction equipment and things like that. Now, given that the businesses are not do not have a visibility of 5-7 years on which these capital equipment need to be depreciated, there is an inherent risk of should there be a descaling in the business going forward, then you are left with a lot of invested capital that you need to deploy to keep the margins in some range. And we do not want to come under that pressure. And secondly, if you look at it, the entry barriers in the EPC margin are absolutely non-existent. And hence, as the volumes grow, the new players will keep on coming in. And hence, it is not going to be a value accretive business based on the deployed capital and the employed manpower. So it is a considered view of the management to stay away from self-execution, because then we will be competing with our own supply chain, which is the subcontractor base.
I can understand you, sir. But our subcontractor got around 25 crores of profit, which we got in Delhi Merit only. The profit is sharing by both of us, and he is also getting 25 crores around, I think.
So please...
17 crores of that early bonus for him, and 17 for Welspun. And other running profit, he will be earning something, sir. As the competition is gearing up, with a lot of workers coming up, no subcontractor will be quoting for lesser rates. He will ask all the premium rates. Because there are works everywhere in the country.
As I said in my address, I have been able to close all the contracts for the projects that we have won within the cost that we had estimated at the bid stage. So it is not true that the costs are escalating as far as the subcontractors are concerned. Also, there are very few players who have a pan-India ability to be to efficiently self-execute. However, if you are self-executor and you get a project in Karnataka or in Tamil Nadu, you need to deploy your own equipment and your own manpower and bring in inefficiencies. So there is a risk. We are very much also a prudent risk taker. When you subcontract certain things, you have an ability to de-risk the main company by taking certain documents of negotiation, having certain cash blocks of the subcontractor, etc., which allows us to protect the main company from any vagaries that may happen. So I think it's a prudent decision that we have taken, and we are very successful till now. However, I have taken this recommendation of yours in a note of, and if you need to discuss this with you can call me.
Yesterday in your results, you have disclosed that you are going to bid for 330 billion. So at this juncture, definitely it is required for our own team to execute one or two projects. If any subcontractors leave in the middle, we can execute them.
Mr. Raju, since it is getting to a detailed question and a philosophical question of how to conduct a business, I've taken note of your recommendation. I would suggest that if you feel strongly about it, let's take it offline.
Okay, sir. Thank you. And the other thing is, last year our treasury income is 75 crores. The remaining income is only from business, which is comparatively less. I feel that this year we can deliver more.
I am equally, as I said, equally hopeful about it. Thank you.
Thank you. Thanks a lot.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Shravan Shah for closing comments.
Yeah, thank you. Thank you, everybody, and thank you, management, for giving us the opportunity. Sir, do you have any closing comments?
No, thank you. Thanks for organizing it, and thanks to the investor for coming on the call and raising the questions. We appreciate it. Thank you.